And today I'm really excited to talk to Zack Brittain.
Here in Waterloo Region. These are just some screenshots I took literally the other day. These are all posts from, the last couple months about small infill projects to new massive economic development and reinvestment from the city and the region and Ontario government, or private developers building, the new largest condo tower here in Waterloo Region. And in Waterloo Region, if you look at the next 10 years, I'm like, oh, it's a no-brainer. It's going to keep growing like crazy. Looking at 25 years, like, Jesus, it's going to be a massive city by then, right?
Yeah.
In 25 years, we'll be over 1 million people. All right, we're about 600,000 now-ish, give or take. Look at this map, guys. Look I should have gone into art. Instead, I got into real estate. This is the Phipps Brittain custom.
Is this a treasure map, Zack?
This is So what I highlighted here was the fluorescent green is kind of like within a kilometer walking distance of the Ion Rail, the yellow highlighted line that goes through there. And everything within a kilometer distance of any one of these Ion Rail stops is going to get redeveloped. So if I'm an investor, which I am, do I think those areas are going to appreciate better or worse than all the other locations in the region?
Follow the money.
Follow the money.
All right, welcome back to the Canadian Real Estate Channel. My name is Luis Rivas. I'm a real estate investor and coach with Wealth Genius. And today I'm really excited to talk to Zack Brittain from Kitchener, realtor, investor, and an all-around exciting guy to talk to. Zack, what's exciting in your world today?
We've been off for a month, Luis.
Ooh,
we usually
that's
do these
exciting.
every month. We took a little bit of hiatus, which wasn't bad timing because there's a lot of stuff that happened, but not that fast in our market. So I get to come on here, share, what I've seen the last 30, 60 days, what I think's coming up the next few months. I got to take some personal time too. We got a young child. She's 6 months in a couple weeks. So, I had a lot of baby excitement in my life last few weeks, a little more time with her. But, back to business. Back to the battlefield. Back to the battlefield, yeah. So I know you're an Ottawa guy, but I also know you got a lot of people in your network, investors, people in the real estate business that are kind of down my way.
Yes.
And we get a lot of people on the YouTube channel here that are all over North America. So I'll make some, if you guys have seen our videos before, I'll make some comments that, you guys already know about Waterloo Region, you already know about me. But for the new viewers, the new listeners out there, I want to make sure I get everybody up to speed on just the 1,000-foot view of what you need to know about Waterloo Region. And Luis, I know if you're talking to your students or your clients, if you're learning a market or you're trying to execute a market, obviously working with people in that specific market to identify the right types of deals for you guys and girls out there. So, take this as a quick, overview, the most important stuff you need to know about Waterloo Region. If you do have specific questions, hit us in the comments. All of our contact information is on the links. And you can follow us on our Instagram page that we're super active, getting back to messages, either hopping on a quick call or sending you any guys resources you need. We're pretty active on social media. We're happy to help there.
Sweet.
But this is what we're covering. We're going to do June, kind of what we've seen so far in July. One thing that I really like doing, that I've gotten some really good feedback from the viewers, Luis, and I'm excited to have you chime in on some of this stuff too, is like what investors can do now, or given the current climate and where we see the next, 3 to 6 months going, what can they do now to prepare if they need to execute before the end of the year? I like talking in scenarios. If you have an investor that's, fitting X, Y, Z, maybe we look at, these types of deals or this type of refinance, so that you guys that are watching can kind of figure out, okay, well, that's my scenario. Maybe I should start looking into those items. I want to go through some of those. Developments in KW. We're going to end up with some garden suites and how we're finding value in the current market, so that if you guys watch this video, at least you have an idea of what's going on now, kind of what's coming down the pipeline in Waterloo Region, and then what we can be looking for in the current market to find some, some deals, some value if it's there at all. Okay.
Okay.
So,
good.
Okay. Seasonality is actually back. You guys up in Ottawa, your market has seasonality just like mine. People don't love moving in the winters. They can get pretty nasty. So you get a really busy spring. And actually, you might know this, Luis. What do you think the busiest week of the year for closings in Ontario is? So real estate closings, deals that are keys are exchanging hands, deals are getting closed. What's the busiest week of the year?
I'm going to say first week of September.
Oh, that's actually a pretty good guess. It's earlier. It's the week right before Canada Day, because that's when mom and dad are getting the keys to the new house. School's out. They're moving to the new home for summer, so the kids can get in the new school in the new school year in September. Right? Your guess was right though. That was a good one, because right before September, there, everybody trying to get in for school. But
yeah, you're right.
We see all this. Our market does wild swings, because you have no listings on the market in December, very few in January, not that many in February, and all of a sudden March, April, May, June, just boom, the number of showings, volume of new listings, prices typically peak in that, May, June months as well. And then they slowly start to taper off in the summer. The summer isn't as busy as people really think it is in real estate. Everything slows down a little bit. There's less new listings. Right? There's less showings on those listings, and prices typically take a little bit of a breath. And we all know what happened last month or two, another couple interest rate hikes. We're going to sprinkle that on, and we're expecting the summer to really slow down a little bit here in KW, right? But what I thought was really interesting was showing activity doubled. This June, there was just over 2,000 showings on this one showing app that we use to track this data, Broker Bay. They track the volume of showings in specific areas. There was twice the number of showings in June than there was last June. Because as you remember, Luis, interest rates were coming up and prices were just getting crushed last year. Nobody was out looking for properties.
The bottom just went plummet.
Quickly.
Yeah.
Quickly. So what we noticed is showing activity hasn't dropped as dramatically from the interest rate hikes this spring. I think a lot of buyers and sellers and investors were already pricing a little bit of the interest rate hikes, but I think they've come up a little bit higher, a little bit quicker than a lot of investors, especially, we're really hoping for. We like that cheap money. So, any sort of change that isn't going to negatively affect the pocketbooks isn't going to be as welcome. But a lot of this is kind of mixed up into a ball to really say, hey, the traditional seasonal trends in Kitchener-Waterloo, region have come back from before COVID. COVID messed everything up in terms of, prices all over the place, showings all over the place, wasn't following, kind of the seasonal calendar. Now we are definitely back. Expect the summer to be a little bit slower. Expect showings to continue to taper off. There's not going to be that many new listings, but inventory has ticked up a little bit. So what that means is if we're following the seasonal norms in terms of number of new listings, number of deals being done, but inventory is coming up a little bit. That means some properties are sticking on the market a little bit longer than they were about 30 or 60 days ago. So in the spring, I don't know how hot it was up in Ottawa, but here, a week or less, properties are moving, likely multiple offers on almost everything. Now we're seeing some of those listings kind of just sit just a little bit longer. Oh, and then last but not least, the spicy ratio. I was trying to come up with a better term for list to sale price ratio, because it just—
I like it. I like that.
Right? Because if the ratio is high, okay, then it's a spicy market. So what I mean by that, guys, is if you're, to give an example, our list to sale price ratio, it just fell for the first time this year. It started at about 100% in December, January, and then ticked up a little bit every month this spring, and it stopped at 111%. So that means on average, the listings were selling for 11% over asking price. What? Like,
it shouldn't make, that doesn't make sense. It shouldn't be that way.
You would typically expect historically, it's below 100. In Ontario, the list to sale price ratio was below 100, right? Typically, it's kind of around that 93, 94, 95%, depending on your market. But in Waterloo Region, we haven't had it under 100, I want to say, for more than a month or two in the last 6 or 7 years. It's because their inventory is so low. So I really want to highlight inventory is ticking up a little bit, not enough to make a huge difference yet, but there's more properties for people to view. They aren't selling as fast. the list to sale price ratio comes down a little bit. So it's at 109.5 on average. If you guys know nothing about Waterloo Region, expect the listings that you're looking at on average to sell about 9.5% over asking price right now. We expect that may come down a little bit throughout the summer. So we're just going to go over this real quick. I hate looking at walls and numbers. I'm a big stats guy. You know, I studied economics and finance. I really like that. I really like numbers, but obviously there's a lot of context behind these that I just want to cover as quickly as possible. I just put there in red. I don't know if you guys can see it on your screens here, but in red here, this is the median sale price for a detached home, 889. So about 900K. That's the median. On average, they're selling for $1 million. And we're going to come back to this as to why that detached homes are at a higher price in June this year than they were last year. Right? So we've come up to where we were before. And what I think is really interesting is you look at the townhouses, you look at the condos, they're still down. Right? Condo and townhouse prices are down compared to last year significantly, almost 6% and almost 9% in KW, and even more out in Cambridge. Now, side note, if you don't know anything about Kitchener, Waterloo, and Cambridge, 3 big cities that grew into each other, Cambridge is on the 401, closer to the GTA side, right? And a lot of the townhouses and condo style buildings in Cambridge are a lot newer. And so those properties were selling like crazy, selling like crazy, selling like crazy. And now a lot of the new sales have slowed down. Their prices are at 660 and 481. Those prices have slowed down a little bit. And developers have stopped bringing a lot of those to market, or at least tried to sell off their inventory before they keep bringing new ones to market. So that market is just a little bit more volatile, guys. It's much more specific with specific pockets and neighborhoods in Cambridge as opposed to Kitchener and Waterloo. So if you have specific questions on that, just be a little bit careful when you guys are looking at this broad, median, and average data. I know for you, Luis, when you're researching types of properties or specific markets, yeah, you want to consider kind of the market as a whole to get a gauge for the overall health. You know, what kind of playground are we about to play in? But then you want to go to the specific, type of property or the specific locations and really compare apples to apples there, right?
Yeah, absolutely.
Okay, so I did want to just talk about the interest rates because I know it's important. It's been changing a lot. It directly impacts us as investors, myself as a real estate sales representative and our clients. I read an article actually this morning on Wall Street Journal about the investing community getting a little bit more, and the business community getting a little more confident that this soft landing, the American and Canadian governments were talking about when interest rates first started going up. And they're thinking it is more and more of a possibility of getting a soft landing as opposed to an actual recession. I had a good laugh at that because when they first started saying those things about a year and a half ago, I was just like, there's no way you can have a soft landing if you ratchet up interest rates as quickly as they have to. But we are starting to see, the CPI cool a little bit. We're starting to see a lot of effects from the interest rates that were changed 6 to 9 months ago, just really start to kind of hit the Canadian economy. But the most important thing here, I think, for me and you to have a discussion, Luis, is sensitivity to interest rate changes. And so I know you work with all types of people. For myself as well, from first-time home buyers, people my age getting their first townhouse or condo, all the way up to, mature clients who have a whole portfolio of properties. Yes. And what I want to get at here for the people watching the video is different people have different sensitivities to these interest rate changes. So I'll go back, see the townhouses and the apartment building style properties, right? Those have not quite recovered as much in terms of price, whereas detached homes are back over $1 million, right? And this just gets you thinking. It's like, okay, well, people typically at higher price points, or investors who have capital, who have other properties, who have equity, who have a network, these people typically have more flexibility above and beyond whatever mortgage the bank is willing to give them when they walk into their branch, right? So if I'm less sensitive to interest rate changes, then and it's easier for me to go and make a move in the market with more confidence because I have the financial flexibility or the resources to handle the short-term volatility in interest rates. Make sense, Luis?
Yeah, makes sense.
So what we're seeing is people that are in the more affordable side of our price ranges, your townhouse, your semis, your apartment style condos, your stacked townhouses. There's a lot of competition in those, but we also see a lot of buyers and sellers get taken out of that market a lot quicker than people who are shopping for detached homes in the million plus price range. So what we find is similar type of idea carries over into investors. Investors, typically they'll have more financial flexibility and more of a network to rely on, whether it's private lenders, B lenders, other investors, partners, other properties that they can take cash flow or equity from to offset maybe a property that's not making money every month. And so those people are less willing to maybe sell a property at a lower price point, or maybe less willing or have less of a motivation to offload properties or to bend to the current market conditions because they just don't necessarily have to. Whereas if you are one person with one mortgage and you can no longer afford it, you have very few options, at least in the eyes of most people who are typically homeowners. And what we've noticed is there's a lot of investors that are heavy in the equity, or they're in the red a little bit and they're willing to ride that wave out until they can either reposition the property, reinvest in it, or sell it at a more favorable price. In Ottawa, have you guys noticed prices for multi-unit properties, really dip down to really juicy levels lately, or are you seeing them be really sticky in terms of price?
Multifamily,
yeah,
has not fluctuated. It has really maintained its cap rate. And it's very frustrating, but the cap rate has not, it has not really been impacted by, the interest rate shenanigans.
That's a great way to put it, interest rate shenanigans. And I just think that it's good to hear from another investor. When I'm having conversations with other investors, it seems like it's easier to get to that point. But for you people out there that maybe haven't been active in the market for a few years, or you're considering like starting your portfolio, whether you're saying, hey, Zach, hey, Luis, I want to buy this year, or, I really want to get my ducks in a row, understand all my options, my financing, what markets I want to go to, like do that now. I think that's really important, but also understand that if you're expecting the interest rates to crush multifamily prices and values, so much so that you're going to get I can't lose price, the I can't lose price deals, those deals are made. Those just don't fall out of the tree and land in your lap. You have to go out and make those ones happen. And usually it's a win-win for both the seller and the buyer. There's no investors out there that are fire selling a property on the market or off the market at such a steal price that you can't lose. Those are so rare. And I just would not rely on that as a sound investing strategy. However, what I would rely on is, and we're going to talk about this after we get into developments and ADUs and where we find value, is long-term trends. Long-term trends. Am I investing in a market where the population's growing? Are they spending on economic development? Are they building new infrastructure? Are there people coming and staying there? Is the employment strong? Like those things should help you identify, like I said before, the playground you want to play in. And then you can figure out, all right, do I want to go to the jungle gym? Do I want to go to the slide, or I'm going to go on the swings? You can figure out kind of which type of property you really want to get into. And we've noticed the same thing here in Waterloo Region. Cost per door, cap rates, they're not necessarily getting that much more attractive, guys.
No.
And if you think about it even further is, I don't like comparing our city to the GTA, but I like comparing to where our city is at compared to the GTA. And I think Ottawa is slightly similar situation in the sense of they've redeveloped and reinvested significantly in transportation, downtown cores, same with ours. Build up the city center, redevelop it for what everybody wants, and then we can build out, because then people can move into the downtown city center for all their fun and all their activities and everything they want to do. And so for us, I'm going to go back to our slide here, working on one screen here, folks. If you guys want to learn about what deals we see in Waterloo Region, we have a weekly hot list. I send out my blurb on what I think is kind of going on in the market, what I'm noticing in terms of price trends, if we're seeing multiple offers, if we're seeing, no deals, if we have anything off market. It's on the Phipps Brittain Real Estate Investor Hot List. It's totally free. We just share our 2 cents. We share if there's any good deals and what we're thinking about the market. There's links to the listings on our website, so you can go through them on your own. You like something you see, or you want to hop on a call, or you have questions, then you can just email me back and you get right back to me. It's not a bot or some sort of minion of ours. It's me. So you guys get full access to all that stuff. Go over to our website. The contact us is right there. Then you could fill out the form. If you have specific deals you're looking for, like Luis is saying, hey, I only need 100 plus unit buildings, or I'm looking for duplex conversions, or I want a single family flip, or, I'm moving from the GTA, but I'm thinking about, maybe a live-in house hack investment property. Give us some info and we'll see if we can't get you the deals your way. Really good intro way to kind of learn the basics of our market for people who are considering either moving or investing here in Waterloo Region.
Super. And you said you publish this weekly?
Every week you get an email from yours truly. I'm going through, me, I'm a junkie. I look at all the listings. If we haven't already viewed it in person, then we've already reached out to confirm the financials and compare it apples to apples to the other deals that we've seen. Quick 1 or 2 line blurb on why we think it could be a good deal and what type of investor that deal would fit well for. And then if people are interested or they have questions, then no problem. You just email me back and away we go.
Super.
Yeah. So I want to talk who's winning now, kind of what we're seeing for different types of investors. We work with a lot of people that already have property. We've helped a ton of people acquire small to mid-level multi-unit properties here in Waterloo Region, all Kitchener, Waterloo, Cambridge, and some of the surrounding areas. And I did just re-highlight the price sensitivity and the financial flexibility. A lot of my people are making calls in the spring saying, hey, I'm thinking I might offload this one. I got a refi coming up, or, maybe should we, go build 2 or 3 units off the back of that one, or refinish a few of them to increase the rents and keep it for another 5 years. Those are the conversations investors are having right now. Yes, some of them are saying, man, my variable mortgage is really eating into my cash flow, but my property value's, up a few $100K. My mortgage isn't up for another year or 2. I'm probably just going to see where interest rates land in the next 6 to 12 months and start making decisions based on that. They don't have, I've had some conversations with people that do need to sell, right? It makes sense for their portfolio, or, they're on the tail end of their career and they're looking to cash out in case something does happen. But ultimately, if we have people that are operating properties that aren't really good for them right now, it's not a conversation of, okay, let's dump this property, because ultimately, Luis, you've been investing longer than I have. A lot of the wealth is made in the hold, and how many assets you can keep in for how long. And so we want to help all of our clients explore all of their options, not just, you're not making as much money on this every month as you want. Okay, dump it. Let's get it up on the market. Well, maybe we should sit down and have a look at the big picture. What other properties do you have? What's your long-term strategy? Short term, even though interest rates are high, is there a way for us to reposition the property and keep it, because that may be in your long-term, best interest. And I know those are conversations you're having with your coaching clients. I know the goal setting and big picture is really important to establish, and we want to consider that as well if we're having conversations with people who own property.
It's important because if you don't, people start panicking in this kind of landscape, and then they fall into like the shiny object syndrome, where they're trying to look for that other asset class that might be the home run or the silver bullet, and then it didn't work, and then they're on to the next, and it's like, wait a second, let's just stick to the basics.
Basics are the best. I'm a simple guy, Luis. Just find a good property. Don't overextend yourself. Hold it for a while. Doesn't have to be that much more complicated, right?
Even a little bit boring is actually kind of good.
Boring is good. Boring is good. It doesn't have to be sexy all the time.
Boring can be sexy.
Luis, me and you, we make it look good, but it's not always that easy. It's not always that easy. It's because we're looking fresh today. But real estate investments, they don't always look that good, guys. No. I like the idea of it being boring, because that means it's simple, right? And simple is good. So what we've noticed too is, a lot of our investors who invested, started buying 4, 5, 6 years ago or longer, a lot of them are heavy in the equity, right? And the refinance options, even though the prices may be a lot higher for them, they could get access to a lot of equity. It's way more expensive than what it was last year or the year before. So, and that's great. You have flexibility, explore those options. Maybe consider getting some HELOCs and privately lending. Maybe consider getting some partners, because you can offer, construction lending or financing for the renovation project, but you don't have the down payment capital set aside. There are so many options as an investor if you have equity, right? So just know that you're not necessarily handcuffed, but a lot of our people are starting to position themselves so that when we do have clarity on where the interest rate environment's heading, when we do have clarity on which way the market's going to be heading for the next, short term, we'll call it 1 to 2 years, that they have powder, one of my clients say, dry powder in the chamber, which is his term for cash in the bank, ready to go. And so I think that this is a big transition period for a lot of investors. Get yourselves ready, understand your financing, and be ready to pick up some deals before, the prices just keep going up. And so a lot of people are having that conversation, hold, or do I keep it in the red and do I hold it, or do I offload it? Reach out to your local professional, whether it's myself here in Waterloo Region or whatever other market you're in. Like, look at the people who are holding real estate that are either more experienced than you or doing the types of deals that you do or want to do. Ask them what they're doing. Like, this real estate community is a lot more open than people think. There's a lot of people out there that would be happy to help you and see you succeed. So call them. Right. That's what I do.
I love it. I love it. And I love the fact that you mentioned a lot of different options, like leveraging RSPs, and like people don't talk about that, but it's a huge untapped market in my opinion.
Yeah. Tax deferred, baby. Avoid the taxes. It's and there are way more options than I think people think of. And it's just because you don't know them or not popular doesn't mean they're bad, right? There's a lot of people out there that are trying a lot of things to make money, and understanding all your options will just help you make the right decision. Straight up. So 2 things for looking to acquire. Personally, I'm always looking to acquire. Most savvy investors are always looking for a deal. There's always deals to be made out there. Good deals sell fast. That's all I'm going to say. Good deals sell fast. Vacant units, A+ locations, really good condition, really good rents, or a combination of all those 4, property is gone in a week or less. If you're looking at 10+ units on market or off market in Waterloo Region, those are gone in a week or 2 tops. So like, if that is your wheelhouse, if that is what you want to do, that is awesome. But just be prepared to continue to compete in that space. Straight up. That is a competitive space. Now, last thing, and Luis, this is one thing I really want to talk to you about because you have more experience, a longer experience than I do in real estate, is cash flow is getting pinched. So what I mean by that is prices for multi-units haven't come down. The cost of lending and borrowing has come up. The juicy monthly cash flow for a lot of investors, right? So what we are looking at is lock in the prices in the desirable locations. And we'll talk about the desirable locations after this. But in an environment where cash flow is getting pinched, what are some ways that you are maybe helping, your clients or, your students kind of really focus on those hot markets that are competitive? What are they doing to find cash flow?
Well, the word creativity comes to mind, and vendor take back mortgages and getting the seller to finance is a good one.
So stop right there. If you guys don't know, you don't have to go to the bank for the lending. And if the bank won't give you the lending you want, maybe you ask somebody else. Crazy idea, right? I love it.
Yeah. Agreements for sale, which is basically you take over the property and you try to bring it, the NOI up to to the level where it kind of matches the price tag, and you close on it in the future. I know that might not be a popular one for agents because the closing's delayed, but that's another creative move, and also looking at the secondary and tertiary markets surrounding that are supporting that primary market, like Chatham kind of supporting KW and whatnot, and maybe even outside the edges of Chatham. You know what I mean?
I think that there are the creativity piece is like kind of like a catch-all, because there's, until you know the deal or the scenario, there is like a million different ways to put that one deal together. And so I think what I just want to piggyback on that is you have to be active in the market to understand what the deals are out there. You could say no to 100 deals until you find the right one, but the chance of you walking in and finding the right one first, 0.
Oh my goodness. Big. And there's nothing wrong with going through 100 to find that right one, but everybody just wants to like one shot, one kill. Like, just get out there and just uncover as many stones as you can.
Yeah, I laugh because sometimes I'll show clients maybe about 10 places, and none of them really kind of tickle their fancy. Like, oh, Zach, I don't want to waste your time. And I'm like, man, I look at almost 10 places a day, just whether it's myself or for the clients, like just to know what's going on and to be able to find some good deals, guys. Like, I don't care if I show you 10 homes or 100 homes, as long as we're getting closer every time to finding the right opportunities so we get more swings at bat. That's the name of the game. Like, the quality is in the quantity, right? As long as you're narrowing your criteria, you're focusing on the right types of deals, and we're actually trying to put deals together, I don't give a shit if you look for 10 months in a row or 1 month in a row. Does not matter. Ultimately, figuring out what deals fit your criteria and are actually possible in your market. If we look at those, you'll find a good deal eventually, right?
Yeah.
And so I really appreciate your input there. I think creativity is going to be huge. I think more deals are going to be made in the next few months than had or found, if that makes sense.
Created.
And so,
yeah.
Yes, exactly. And so how do we find the deals, Zach? We follow the money, Luis. We follow the money. Here in Waterloo Region, these are just some screenshots I took literally the other day. These are all posts from, the last couple months about small infill projects to new massive economic development and reinvestment from the city and the region and Ontario government, or private developers building, the new largest condo tower here in Waterloo Region. Now, I've previously talked, I'm not sure if it was on the Canadian Real Estate channel, but definitely on my Instagram and on some other outlets that we've, done some stuff with. There are developers and builders who are, scaling down investment. That is the short term. And when I say the short term, I mean less than 5 years. But we're looking, I'm a long-term investor. I want to look at something and say, does it make sense? If I have to hold this forever, does it make sense? And in Waterloo Region, if you look at the next 10 years, I'm like, oh, it's a no-brainer. It's going to keep growing like crazy. Look at that's 25 years. Like, Jesus, it's going to be a massive city by then, right? Yeah. In 25 years, we'll be over 1 million people. All right. We're about 600,000 now-ish, give or take. But we're seeing, large single-family lots, top left, get proposed for, 10 unit stacked townhomes. Then we're also getting, our old Schneider's plant. If you guys remember Schneider's, big, huge family business out here in Waterloo Region. They had a 25-acre factory that got decommissioned in 2015, and it's done nothing since. Sold a few years ago, and now they finally got approval, and they're doing, I want to say, like 3,600 units plus commercial space plus retail space.
Wow.
And this is like 5 minutes walk from downtown Kitchener. 5 minutes down the street to Victoria Park, 5-6 minutes straight shot to City Hall. You're right off the LRT stop. There's 2 LRT stops within a stone throw of it. And then all the vacant lots or all the big commercial lots with big parking and small buildings, those are all getting proposed for condos. They're all getting proposed for apartment buildings. They're all getting redeveloped because look at this map, guys. Look at, I should have gone into art. Instead, I got into real estate. This is the Phipps Brittain custom.
Is this a treasure map, Zach?
This is this is exactly what it is. This is a treasure
You heard
map.
it here first.
So I was looking, there's got to be somebody else that's already done a development map that looks good. I couldn't find a good one, so I was like, screw it. I'm getting the art tools back out. So what I highlighted here was the fluorescent green is kind of like within a kilometer walking distance of the Ion Rail, the yellow highlighted line that goes through there. I've talked about this before, Luis. If you're within a kilometer of that area is going to experience the largest amount of intensification and redevelopment because that's where the people are. People can get transported to and from, North Waterloo all the way to downtown Kitchener, Fairview Park Mall out by the 401. And then it's going to go from the Fairview Park Mall area all the way out to Cambridge. It's going to follow the major corridors, and everything within a kilometer distance of any one of these Ion Rail stops is going to get redeveloped. Apartment buildings, condos, mixed use, like anything that's empty space, anything that's run down, anything that's a parking lot is either already zoned or approved to be built as a condo building, apartment, or mixed use. So if I'm an investor, which I am, do I think those areas are going to appreciate better or worse than all the other locations in the region?
Follow the money.
Follow the money. There are people that are way smarter than me with way more money that think way further ahead than I do that are already investing in these areas. So for the last 5 years, me and my team have been focusing on midtown locations that are getting cleaned up and getting reinvested, that are 30 to 60 years old because they've had 1, maybe 2 owners, and they're on big lots, but they haven't been fixed up inside. Sweet. I'll take your big lot. Thank you, sir. I'm going to go put 2 or 3 units on it and renovate them all so they're all brand spanking new. Or I'll go in the downtown city center, and that is within these green lines, within about a kilometer walking distance of the LRT or downtown Kitchener, uptown Waterloo, and I'll get those nice big detached homes on freehold lots, downtown, uptown, walking distance to everything. Bonus if you have parking, bonus if you have garage, bonus if you have a big lot, bonus if you have bigger square footage, because then I can just either add more units or more space for me to redevelop and actually make some more money in the future. So The
Makes
little,
sense.
right? I had to laugh. I put Tech Hub. I put the Go Station in here. The H's are for the hospitals.
But
And
you
on this
put a
previous,
triple X there. What's the triple X for?
oh, okay, good call. So those are all condo developments right by the highway. So this area, actually, my first home is actually right by those, right by Fairview Park Mall. Old homes on massive lots.
Nice.
Weber Street and King Street, the most confusing streets in Kitchener-Waterloo. If you've ever driven around here and you don't know the city that well, there's these massive old parking lots and old, hotels and motels that are on big lots that they've smashed down, and they're building brand new condo towers, just like you see if you're driving through the GTA. You see them going through Scarborough, Etobicoke, Mississauga, all along the 401. You got these gorgeous new buildings that are overlooking parts of the city or overlooking the water, and they're right off the 401. Well, right off Highway 78. You are 5-minute drive from anything in Kitchener. You're about 10-15-minute drive from anything in the region if you're parked there. So, and you're walking distance to the mall. You're walking distance to every amenity because you're along a major thoroughfare. Makes sense.
Makes sense to me. This is a transit-oriented development map.
Yeah.
This is
So
the treasure map.
similar to Edmonton or to Ottawa, Ottawa's an old city.
Yeah.
And like, you know what I mean? Like, from my experience in Ottawa, the traffic's not that bad considering how big the city is. But
Comparably, yeah.
compared to the GTA, it's awful. But you just see it's like, well, there's so many more people coming to Ottawa, surrounding areas, so many people coming to Waterloo Region because it's much more affordable than the GTA. Well, you have to build around where people can get to. So the major highways and the major hubs, like your LRT stations, like your malls, like your downtown city centers, like your hospitals, all those need to be accessible. So everything around there is going to experience more redevelopment and in turn, better appreciation for us investors, right? So I'm really proud of my art skills. I'm glad you appreciated them too, Luis. So
Way to go.
I think now this is a really good chance for me and you to have more of a conversation about finding value. And for newer investors, like I did actually a lot of these now that I think about it. I house hacked. I did a live-in duplex conversion. I mean, my wife bought a crappy old bungalow, fixed up the basement into a brand new unit, moved in upstairs, fixed up the upstairs. We lived there for a few years, helped keep our costs low. We forced appreciation, got a lot of equity out of that property, used that to go buy our next ones. So you could do house hacks, you could do live-in flips and duplex conversions, or you can get a single family home with a big lot that you can add an additional unit on or put another addition on or another unit in the basement. Like, I wish more people did these because these deals are so much better now with how expensive everything else has gotten that I just see so much more value for younger investors to like get into those now. Yes, it's expensive, but give it another 5 years or another 10 years. It's going to be borderline unaffordable for normal people in the next 10 to 15 years. So I just see these as awesome options. One of the best deals or one of the best types of deals we found this year, actually, Luis, is properties that are set up as a duplex. So in our market, downtown Kitchener, uptown Waterloo, 2-story homes, a kitchen, living room, bedroom in the upstairs, cut off by the staircase, and then a kitchen, living room, bedroom, and the basement on the main floor. Or a bungalow that's got, one unit set up upstairs, but an in-law set up in the basement. It's just not legal yet with the fire separation, interconnected fire alarms, egress window. Like, you can get those 50 to 150,000 cheaper than you can a legal duplex, and they're going to cost you less than 50 grand to convert into a legal duplex. So love those deals. Love those deals. Now, we also got up top here, the fix the problem, condition, income, and features, right? In our market, a large disconnect, and in most of Southern Ontario and probably almost anywhere in Canada, is the purchase price specifically for single family homes and all the way up to multi-units compared to the rent that you'll be able to generate. That's what I was talking about before. The interest rates kind of pinching and the price is kind of pinching our monthly cash flow. So I like to think about it like this, is what is the problem I'm fixing with this property for it to make sense? And is that a problem that I have control over, or is it a problem that's very out of my control and that I don't think I can fix as easily? And I'll kind of gauge that. So for example, have a property that's getting good rents, but the condition's just very poor. Okay. Is that easier of a problem to fix than a property that's good condition, but has very poor rents compared to the price that they're asking? I have to ask myself, well, do I have experience fixing that problem? How likely is it? And how much is it going to cost for me to fix that problem in terms of time, money, and resources? And so I like to think about it from that perspective. there's also features. Like, is this an amazing location? But the rents and condition are crappy as well. But it's got all the right features. It's got the location, it's got the parking, it's got the storage. But every other component of it sucks. Okay, well, how much is that going to cost me, and what's going to be my net result? So I just challenge people to really think about, their real estate investments, whether they're going to acquire, they're managing their current ones, is what's my biggest problem with this property, whether I'm acquiring it or managing it, and how easy is it to fix? And if you don't have a fix for it, talk to other investors, right? There's probably people that have done that type of deal 10 times over, right? And then go ahead.
Do you give do you weight it? Like, do you say out of 10, or like out of 10, like, how can I fix this? Or out of 10, how bad is this? Or is it more of a gut feeling?
That's a really good question. And I think it really depends on the investor, right? Like for myself, I know the problems that I'm willing to fix and that I'm good at fixing. I know how expensive it's going to be to do specific renovations. I know how it's expensive to, add a new unit, or to, repave a driveway and add the garage suite. Like those things are, cost of how do I fix or add. The cost of dealing with tenant problems, right? The cost of adding brand new features that aren't already there, in suite laundry, or, the plumbing, electrical, and utility systems required for an ADU or an addition at the back. And a lot of people don't necessarily understand how to break those down. And for me, it's how comfortable am I? So, are the rents 50% of what they should be? Okay, that's a much bigger problem than, they're 80% of what they should be. Much bigger problem.
Is 80% even a problem? 80% is like, in Ontario, is like,
no, your property's probably cash flowing, or at least break even with 20% down. If you're getting 80% of market rents and the seller isn't totally unrealistic on their price, like I kind of like those deals, right?
Yeah.
So, and also I think you kind of take a step further, and this comes with the experience. It's think about the end in the sense of, who do I want to rent to? How likely is it that those people are going to be here? How quickly are those people turning over? So for me, I want all my stuff is going to be either whether when I acquire it or after I acquire it right away, I need to make it about a 7 out of 10 on the condition scale or better. And I'm typically looking for young professionals or young families. One, they're easy to manage. They don't have unrealistic expectations in my experience so far. Two, they typically turn over in 5 years or less. When you're young, your life changes a lot. New work, new partner, kids, new schools, new job opportunity, whatever. Lots of changes between your, 20s and your 40s and your 50s. Kind of once you get your 40s and your 50s, you're tired. You're settling down. You know what you want. You're not going to be as mobile. So we really like that 20s to kind of 40s window, because they're easy to work with. They're happy to pay a premium for clean and nice, right? And so we've already kind of thought about that profile. And so we thought about, is this a location? Does it have the features that they want and that they're willing to pay what we want them to pay for it? And I think just kind of taking a step back from the numbers and the analysis of things, and just really considering, do like the people that I actually want to work with, because you do have to work with your tenants, guys. These people are going to be, suitable for what I'm looking for here. And a lot of that is just kind of sitting back and looking at it as if you were them and putting yourself in their shoes. And then I wanted to just talk about this deal real quick. This is a good fit. This is actually one of our listings. I'm not going to share as many listings on the Canadian Real Estate channel, videos anymore. On our investor hot list, that's the best spot to find them. This is one of our own listings, so I can share this one. That black or that red arrow there, the back roof behind there is actually a 2-bedroom, 1-bathroom unit with a basement and its own furnace.
Wow.
When we purchased this property, it was like an ADU before an ADU. It's attached at the back corner though, so it's technically not a detached unit. So we got a 3+1 bedroom bungalow, and then a 2-bedroom unit out of the back. And this bungalow is actually got a side entrance into the lower level, so you can add a legal 3rd unit in this property. So we liked this deal when we purchased it, because we said, okay, well, we can add a 3rd unit if we want more cash flow, but we got great tenants already. Let's just acquire it and maintain it as is. The back unit has been updated. It's brand spanking new. There's parking for about 6, 2 storage sheds plus the garage. There's a side entrance to the lower level. So if you want to purchase a property like this and add a 3rd unit, you can maybe bump the equity about $100K and add, probably about $1,500 to $1,800 in cash flow like that. And it costs you about $25 to $40K depending on how nice you want to do up the lower level, you got to add in a kitchen and put up a couple walls. Done. So this deal,
1,500 in cash flow or in like rents?
in cash flow, because the amount that it would cost you to acquire and actually put the third unit in the basement adds up to about net positive about 1,500, because you're assuming the tenants upstairs would have to move out in order for you to do the renovations, or you'd have to negotiate a new lease for them to only get the upstairs instead of the upstairs in the basement. Kind of the math that I did was like, all right, if we're being conservative, you're about 1,500 after it's all said and done every month. This type of property is really unique because it doesn't have that detached ADU, and it's not a traditional up-down duplex. So like owner-occupier, even a first-time home buyer, you could live in the basement on the cheap, rent out the upstairs and the back unit, or a multi-generational family that needs a lot of square footage in a few different living spaces. It's on a crescent location. It's very central. So, we like this one. That's why it was picked up in the first place. So you guys can email me on this one or shoot me a direct message on Instagram. We'll shoot you all the details. It's available for viewing as well. A-plus tenants in there right now, makes $2,600, $2,700, or sorry, $4,600 to $4,700 a month in gross rental income. If you put the third unit in the back, then you're looking at about $6,500, $6,400 a month. So we like that one. That one could be a moneymaker for you guys. I don't think it's a good fit for kind of the bigger investors if you're looking for multi-units. And we'll just blaze through this real quick because we're running a little long on time. But the multi-unit investors that we're seeing, with success, Luis, they're willing to lock in the prices now for a premium location or, a premium cost per door count, because they see what we see. Long-term, value is going to get pinched in the bigger markets. It's going to quickly become an appreciation play for a lot of investors that want to get in the bigger, multi-unit space. We put a big premium for our investors on properties that either have the premium locations, larger lots, garage spaces, or parking spaces. And if those aren't options to you investors out there, consider reinvesting in your current holdings, right? Consider private lending. Consider repositioning some of your lending or some of your finances so that you're ready to rock and roll. Because there is a big shift happening right now where a lot of the small to medium-sized players are getting pushed out, or they've made so much good money, they're ready to leave. And what we used to consider mid-level real estate investing is going to start getting gobbled up by a lot of the bigger players because there's just not enough of it out there to go around, right? People who are like only willing to look at 50+ unit buildings, okay, well now they may be willing to take a swing at a 15 or a 20 unit building instead because there isn't any other options for them. And so what we've seen is there's been a lot of competition from some big boys on the smaller properties. And I get it. There's just not enough of it to go around right now. And people are willing to take a chance on other deals now because they can ride out the short-term volatility right now that smaller investors just can't. And we're seeing that come into Waterloo Region here for sure.
I like you said the words happening right now. This shift, this changing of the guard of that money or that those portfolios is happening right now in slow motion, right?
It doesn't feel like slow motion, but when you look at it in a year or two from now, you're like, oh my God.
It's already happened. It's already started, right? And we'll look back and we'll say, oh yeah, it started right around there.
Yep. This is a bigger conversation than what we can tackle right now, but the topic of just general affordability in Canada, specifically Ontario is not an affordable area right now, and it's not getting better, ladies and gentlemen. I wish I had better news. Without drastic changes that I just don't see happening, it's going to continue to become more and more expensive overall for everything, and that trickles down to real estate. And so we're advising our people, acquire as many quality properties as quickly as you can, ride out the short-term volatility, and then cash the checks in 5-10 years, right? Like there's a lot of long-term opportunity, but I think a lot of investors have straight up just been spoiled. 4, 5, 6 years ago, anybody that could get a down payment together could make money hand over fist. And now that it's not that easy, I think there's a lot of disconnect between expectations and current market conditions and reality. And I'm sure you deal with it with your students. I'm sure throughout your investing career, you've had reality checks just like that, like a lot of other investors, whenever there is a big market shift. And the reality is that expectations are different than what's happening in the market. It's going to continue to get more expensive. And so one thing that we've really focused on is is our ADUs and our garden suites. So I've done some filming at one of our clients' projects. We're doing one on our own property right now. We got 2 more lined up on properties that we hold that we'll be actually doing. We're filming a ton of educational stuff, as well as just a lot of tips and tricks. Most people, if you're going to go out there and do an ADU or a garden suite, hire a professional to do it. I've done a few projects on my own, like GC, my very first duplex conversion. So I kind of knew how to work with contractors, the language, what I liked and what I didn't like. And I quickly discovered I'm capable of doing those things, but that's not my highest and best use. That's not my best kind of skill set as an investor. So I'm happy to just find a trusted contractor that communicates well with me, that can execute the jobs, and I'm just hiring them. And so we actually started our own construction business with a partner, and they've been doing a lot of our stuff, duplex conversions, ADUs, and in our city, over 25,000 properties qualify as is. The demand for units will continue to fuel our cities and our regions' willingness to work with investors. You don't need a site plan approval because the city wants and needs these. You bring them your plan for your permits. They're getting back to you in 10 business days or less with the yes or the no, and away you go once you get your permit approved. And the numbers can still make sense. I can build an ADU cheaper than I can go for a cheaper cost per door than I could acquire, a lot of properties in my current market. The cap rates are sexy. I can get, double the cap. I can make double the cap rate than I can, go and acquire it in the current market right now. And so if you are equity heavy as an investor, reinvest in your properties. One thing that we've been kind of suggesting to a lot of our clients, maybe the refinance market's not looking good, but you can tap into a HELOC. Okay, tap into a HELOC, add the value to your property by building an additional unit or 2, and then 2-3 years down the line, if you can hold it, refinance then once interest rates are a little bit better, or do this right before your refinance is up in the next 12 to 24 months because you're going to have to refi anyway. And so one thing that we're looking at a lot of is doing this. And if you guys are going to go follow our stuff either on YouTube or on Instagram, we're going to share a ton of videos on this stuff. I'm actually going to go record at one of our job sites tomorrow.
Nice.
We are doing one, and it's a good little dip the toes in for the big development stuff. If you investors out there have aspirations of, I got a big lot, I'm going to go, put a 50-unit building on that. Step by step, Luis.
Baby step.
Walk before we run. We're going to build a couple of these, and then, okay, maybe we'll go redevelop one of our bigger lots into a small, 6 to 10 unit building. And then we could go up to maybe a 20, you don't need to just hit that home run right away. These are really profitable deals. They can make a ton of sense on the monthly cash flow, and you can control what the final product is. And the kicker, Luis, if you're building them now, no rent controls.
For the first 5 years, right?
Boom. So anything built after 2018, no rent controls on these bad boys right now. I mean, the government could change that at any time, but I'm going to take the win while we can. Right? I'm going to take the win while we can. So
it's still a fact.
Right? For now it is, baby. So if you guys want free quotes, if you have questions about the construction side of things, just pause it right here, kingstreetconstruction.com, or text and call Kevin directly. He has all that stuff for us. If you guys want to learn more about it, though, you can follow us on the Investor Hot List. We're going to share stuff on that. We're also going to share stuff on our Instagram page and on our YouTube as well about how we're doing them, why specific lots and sizes make sense, why we're using square footage or the specific design and layouts. A lot of these will have implications for what we'll recommend to clients moving forward and what we are advising clients on right now. But, we're learning by doing too. Like, I want to go out there and see what these are about. Makes sense for our portfolio and some of the holdings we have. And if you guys want to figure out if it works for you, reach out. Don't be a stranger.
Zach, you have a lot of development in your DNA. Like when you're talking about real estate, you're excited, but when you're talking about development, you're like.
Well, it's kind of the natural progression. It's time, right? We've executed really well on the small to medium sized stuff. I'll continue to play in that playground as long as we see opportunity, but eventually, I think the coolest thing would be to be able to get into some of the bigger projects and then bring some of the clients and investors that we've grown with along. Like, ultimately in my job, people think your job as a real estate agent is to, buy and sell the family home. And it is. I'm great at that, right? If that's what people want to hire me to do, I would be forever grateful and I would love to do those deals. But ultimately, above and beyond that, it's bringing opportunity to the table. And so if we can build our own portfolio, our own resources, our own network to a point where we can bring in other people that have, helped us or we've helped in the last 10, 20, 15 years, bringing opportunity to people that have helped us grow our business would be like the coolest thing ever. So long-term, that's a goal of me and Matt and our team. Right now, though, we're having a ton of fun trying to figure out how to get some good deals in a competitive market. Easier said than done some months, but we're trying. And I get to hop on and talk real estate with veterans like you. And this is fun for me. So that's all we got. Sorry, go ahead, Luis.
No, I love it. I could keep talking to you, man. This is
I know,
fun.
but we've been going way too long. Every week I tell Peter and the Canadian Real Estate Channel, I'm not gonna, but I got too much to say. So if people want to reach out, I'm active on our Instagram. That goes directly to me and our coordinator, Derek. And then personally, all my contact information is in all the videos. I've had a lot of people reach out ready to learn, but not ready to execute. And I love that. I have no problem hopping in a call, explaining, taking you guys to go window shopping, to check out a few options, to really figure out what could be possible. And I'm just parting piece of advice. And I think, without even knowing Luis that well yet, is go out and make it happen. Like taking action, whether it's taking a course or hiring a mentor or a coach, or, going and working with a buddy or a colleague of yours that has done a few deals and saying, hey, just tell me how to do this. That is one of the quickest ways to learn and start executing. And so, I know since you're a coach and since you have lots of students, like you've kind of already graduated that level. I'm not there yet, but for me, those were the biggest periods of growth was, having a mentor, having a coach, or having a partner that had experience with what I wanted to learn. And your mind is just like blown with how much you can learn by even talking to somebody for a couple of weeks. So I thought I'd just leave that there. And I appreciate you guys watching the video and hanging out with me and Luis. We had a good time.
I had a great time.
Easy peasy.
Yeah. And it's easy when you're talking about a region like Kitchener, Waterloo.
Yeah. Oh, yeah. I'm so lucky that I'm in business in this market during this time. Are you kidding me? Hey, but you know what, Luis? I'd rather be lucky than good any day of the week.
We're not lucky. We're blessed.
We're blessed. We're blessed. Absolutely. I feel like it. Absolutely. Well, I appreciate you guys having me on.
Yeah. Thank you.
The break was good, but I'm ready to rock and roll next month.
Sweet. Thanks for coming back, Zach. I had a ton of fun, man. I felt like you brought a lot of value today and a lot of good energy, a lot of positive vibes. My name is Luis Rivas, a real estate investor and coach. Reach out to Zack Brittain on Instagram. Zach, we're going to have you back as soon as possible. And thank you for bringing back those rockin' deals.
Yes, sir. Yes, sir. Thanks, guys. See you soon.
All right. See you.